Well, good afternoon, everybody. My name is Joe Rand. I'm the Chief Creative Officer of Howard Hanna Rand Realty, and I also work with Hudson United Mortgage. And I have here my brother, Daniel Rand,
Hi, everybody.
my much better looking and much younger brother, who is the head. He heads up our the affiliate services at Hudson United, both mortgage, title, and insurance. But we're here to talk specifically about mortgages. And especially what's going on with the housing market in light of this unprecedented interest rate environment. And I know Dan has a bunch of slides. He's got 7 takeaways he wants to share about the mortgage market. And then I'm going to chime in with a little bit about what I see going on, specifically how that's impacting the real estate market right now. So let me get this started and let's move on. 7 takeaways from the third quarter mortgage data. Where'd you get this data, Dan? Where's this coming from?
Yeah, thanks for having me, Joe. We collected the data from the Mortgage Banker Association, which is an association that pools all of the industry's data, and they put it out every month. Great information about the mortgage industry.
All right. And so we have your first takeaway about the rates are at an all-time low, affordability at an all-time high. That's what.
Yeah, absolutely. So rates are low. Here's the graph on the next slide. You can see the 30-year rate index, and it's incredibly low. So let's move to the next slide. You can see the affordability index has ticked up with rates dip down, affordability increases, and that's a great thing. So just moving on to the next slide, you can see mortgage payment as a percentage of income has actually reduced by a whole percentage point. It's near 1/15 or 1/16, which is just a 70% of 1/12, and that's basically a whole month's mortgage payment that's been reduced as a percentage of income. So that's really incredible. And
I mean, let's go back because I don't want to gloss over because you kind of passed over quick as you want to get to the other slides, but like this is remarkable right here. I mean, what you're seeing with interest rates, which when the real estate company, when the Rand Realty was founded in the early 1980s, a 30-year fixed rate mortgage was 17.5%, 18%. And even when we were talking during the seller's market of the mid 2000s about unprecedentedly low, historically low interest rates, those interest rates were about somewhere around 5-6%, but they were historically low at 5 or 6%. And they're now half that. I mean, you can get a 30-year fixed rate loan now for what, about under 3% now, right?
Yeah, we're floating around 2.85 is what we're running at, selling the loans at right now for a borrower that's well qualified.
And I put this slide up just to make clear to people just how remarkable, what a big difference this makes when you have rates as I keep getting the slide. Forgive me, the slide keeps bouncing back. When you have rates that are as low as this, because on the right hand side, you can see at a 2.5 or a 3% rate, $1,000 monthly payment can get you a mortgage of $237,000 and $250,000. That same $1,000, if the rate was at the historically low 6% from a little over 10 years ago, it's almost $100,000 less mortgage you can get for that same payment with rates where they are. That's what's fueling a lot of this, what's going on in the market, right? I mean, this interest rates being this low just creates opportunity, correct?
Yeah, absolutely. And I think you'll see prices increasing slightly because of the increased affordability. And so that would, again, decrease affordability. So that's some of the trends that we're watching this year.
And I threw in another graph, which I use a lot, because you talked about the affordability from a national perspective, but here just is northern New Jersey. We have data going back to 1985, and what this tracks is the monthly payment required to buy the average priced home controlled for inflation for every year for which we have data. If you took the average interest rate for that year and the average price for that year, and then you calculated the average monthly payment for that year, and then you control for inflation, you could see that homes right now, the monthly payment required to buy a home in just about every county in New Jersey, and now I'll show you New York, is lower than it's been in a generation. I mean, this is, I know people say, well, prices have gone up. Well, except that when interest rates go down and prices go up, you can still, it's the same monthly payment, right? That's remarkable. All right, so your second takeaway, tell me about this one.
Yes, consumer trends have changed in how they look at digital mortgage applications. So, when asked, if you move to the next slide, when asked the question of, do you use digital apps for these different types of products and services, you can see in blue, roughly 30% on average are saying yes to the following services. We've circled in green, securing a refinancing a loan, and now 30% of people who are polled are saying yes. They are more likely. Still 60% saying the same and 11% saying less. But this is a larger margin than we've ever seen before. People who are willing to go through a digital application process to submit a mortgage because of the advances in mortgage technology, which is an industry with full of open APIs and full of data and information, that they are now willing to go ahead and use these applications, and they feel that they are secure and quick, and they are. They've improved a ton just over the last 2 years in terms of taking information, rating that customer's risk profile, and giving them an estimate for their mortgages alone. Has just been incredible advances in the last 2 years.
Yeah, I mean, I'll tell you my own personal experience, refi of my home with my wife, and I'm doing it with Hudson United. And I'm at the point now where I think I've cleared all the final, commitment. They ask me for documents. That's the way the mortgage process goes. It's always like, oh, they need this document, they need that document. I have not printed a piece of paper. I have not signed a piece of paper. Everything I've done has been digital signatures, digital documentation. When I've had documents that are confidential, that I'm worried about the security of them, they have a secure portal. I uploaded it to the secure portal, which is encrypted, so that it's not just going out via my email. It's really amazing that you can get all this done now digitally. You couldn't do this even 5 years ago, right?
Yeah, things are faster and more available than ever before with the advancement of technology, and it's really across the board. In addition to applying for mortgages, people are now closing electronically. So my third takeaway is that electronic closings are being widely accepted across the country and maybe here to stay. In New York and New Jersey, we've been approved by executive order, by emergency order, and so that's temporary. It's been extended, but across the country, it's been enacted full time. So
yeah, these are the orders that allow for notarization of documents remotely, as opposed to having to do a wet signature in front of somebody, which is a big deal. I mean, that's getting a notary was always like one of the biggest pains when you're trying to do these documents for these mortgages as well as for title closings, and the ability forced by COVID to allow those to take place with remotely, I think is a big deal, especially if those continue after the public health crisis ends.
Yes, and if you move to the next slide, you can see all the states in dark gray there that have enacted permanent RON laws, which are, like you said, remote online notarization laws. And we feel that the rest of the country may be next. And so this is just a great advancement in closing procedures, and should continue to move things along right through the closing, and cut days in scheduling, cut days from application to close. So these are all good findings in the mortgage industry right now.
That's great.
Because of all of these great advancements, and also we feel because rates are so low, mortgage satisfaction scores have doubled from 2019 to 2020. You can see here the scores are reflect how much satisfaction a customer has with the mortgage process, and right now they're running at 82%, 84% in that range all year. Dipped slightly in July. There was a ton of mortgage applications submitted in July, so I can imagine that may be the cause. But despite high volume and all the issues that we've had in closing during COVID, these rates have doubled. They were in the 40s just last year for refinances and for purchases, and so it's probably a combination of the fact that people are getting low rates and they're closing faster than ever because of these technology advancements in the mortgage industry.
All right. Yeah, I mean, I think that, listen, people are used to doing a lot of transactional stuff online and digitally. The fear factor is not there anymore. And so the more that I think the mortgage industry satisfies that need and plays into that, I think the better the satisfaction scores will be, because people like not having to print and then carry and then drop off and then find a notary to sign. Like, All those things just remove friction in the process. All right, what's next? Takeaway number 5.
This is a really important takeaway for everybody who's in the mortgage business or dependent on the mortgage business, in that refinance units will drop off in 2021 and 2022. We've had a great run this year in terms of mortgage refinance units, and by Q2 they'll be decreasing, and again in Q3 and 4 they'll be decreasing again. And so you'll see refinance units slope off, and there'll be less refinances in 2021 and 2022 than there were this year. This is really the year of the refinances, and once the market refinances, then there'll be less refinances to go around, and less people who have the need to refinance.
Well, that just makes sense that the refinancing would ebb. I mean, at some point you run out of people who can benefit from the lower rates. I mean, a lot of people refinanced in the last wave of refinancing 3 or 4 years ago, who are, I mean, I know I did, and I'm refinancing now, down from a rate that I thought I was going to keep for the next 30 years, which was like 4% or 3 3/4. And I'm knocking off another $1,500 a payment by dropping at a point. Which is extraordinary. But you're right that it would make sense that there's when rates go low like this, people all jump in to refinance, but there's a finite amount of people that can refinance. And then if rates do go up, you'll see, that will slow it as well. But I think a lot of it's just that the lack of supply. There'll just be people have already refinanced. They don't need to refinance again. All right, what's
That's
number?
Exactly right. Yeah, refinances come in a wave and then they go. And so those mortgage originators that have built their business this year on refinances will be looking to build their business on purchase, hopefully in the future, if they're looking to continue.
That's the experience sometimes these real estate agents have, because there's mortgage people, and the mortgage people are beating down their door to get help. Hey, listen, if you have anybody needs a mortgage, everybody needs a mortgage, and then the rates go down and refinances pop, and then you can't get those people on the phone because like they're feast or famine. But I agree with you that what's important from a mortgage loan officer perspective is you maintain those relationships even during the time when you're burdened with, overwhelmed with refis, because the refis dry up and then it's all purchase business. And then you got to go back to get referrals from the real estate agents again and live off that. So you say that purchase mortgage units are going to increase in 21 and 22.
Yes, existing home sales and new home sales should be increasing. So, with that also goes mortgage units, mortgage purchase units. You can see here the amount of refinance, the exact amount of refinance is 1.76 trillion in 2020. So just unbelievable amount of refinance. Purchase was also very strong. It was up year over year. And you can see that in 2021, refinances take a strong dip. They continue to dip in 22, and purchase continues to drive forward, taking a slight dip, but staying basically flat and increasing.
Interesting. Yeah. I mean,
excuse me, this graph looks a little bit off. 1.42 trillion increasing to 1.54.
Yeah, so it actually goes up from 20 to 21 with the expectation that the housing market will have more sales next year than it did this year, which would require more purchase mortgages, and then kind of flat for 2022. So this brings us to takeaway number 7, which leads into what I can talk about. New and existing home sales are expected to increase in 21 and 22 nationally. So these are national numbers. So what's this telling us?
This is just the stock of new home sales. You can see, the percentage and also the volume there. And we're going to be increasing. We're increasing in existing home stock sales and new home sales for the next 2 years.
Yeah, I mean, and new home sales, the problem with new home sales is just they just haven't been able to do enough building to satisfy the need. There's more people would be buying those new homes if there were more new homes being built. But you can see the increase in existing home sales, the increase in new home sales. The expectation is that for the next 2 years, the housing market is going to be relatively robust. And then you have some Mortgage Banker Association data on the Fed funds rate and the unemployment rate. What's the expectation on the economy is fairly optimistic, right?
Yes, this information I got from the Mortgage Banker Association. You can download it. These were my takeaways, but you can go see the raw data there. They have the funds rate remaining flat until 2023 and then slightly ticking up. Mortgage rates will do the same thing, will follow suit. They're expecting in 2023, I believe, like a 3.4, 3.5 interest rate. So slowly just moving in that direction. And then the unemployment rate will continue to decrease as jobs come back and we get a vaccine out. So those are all great trends. You can download this is the economic forecast here, all of this data. You can look and see all of the numbers in detail here. Again, this is downloadable at Mortgage Banker Association or MBA.org. You don't want to go to MBA.com because then you'll be applying for graduate school. You don't want to go to NBA.com because then you'll be looking at basketball stats. It's MBA.org. And this is the mortgage finance forecast section. And you can see here clearly all of the details that we've kind of pulled away our takeaways, but this is the raw data and they put this out every quarter and in addition to every month. So you can see this data as we go, and I'll continue to keep you updated and give you my takeaways through 2021. So some very interesting mortgage market, and we'll see how everything unfolds over the next 12 months. But this is very reliable data. This is also the same association that said it was going to be a great year. I think as early as April, they were saying that forecasting that it was going to be a great purchase year, great refinance year. And when we thought, everybody was very pessimistic, they were optimistic. And so I, give them some credit. They're usually incredibly accurate.
And which leads us, I mean, this is the national data, what we think about the national market. I have some data here on the October numbers, but actually numbers going all the way back to the beginning of the COVID crisis, which show you this is the year-on-year change for the month like of April, May, June, July, all the way to October, compared to last year's April, May, all the way to October. In closings, which are actual title transfers, that's the closing table. That's a sale. Contracts, which are not closings, contracts are, there's now a signed contract, a binding contract to sell the property, but there's a delay because there's time, when you go between contract and closing, you got to get your mortgage, you got to get your title, you got to do a bunch of other things to get from contract to closing. So it's a little bit more of a leading indicator of what the closings are going to be like a month or two down the road. And then there's listings, which is the earliest indicator. Those are houses that have been put on the market in that month. And you can see that in April, May, during the height of the COVID crisis, which I think that things are problematic now, but things in the New York area were awful back in April, May from a public health perspective. And we had the essential services order that largely shut down the real estate industry. Closings were down because it was difficult to close. Contracts were down because you couldn't even show houses in some cases. And then listings were down because who wants to put their home on the market when they're using it like I am as a Zoom studio rather than a living room. And you can see how the market changed in June when the public health concerns reduced a bit and the essential services order lifted and we started to phase in the reopening. And then July, the black numbers indicate where we start to see increases off last year. And you can see that the last 4 months have been crazy in the housing market in terms of contracts, in terms of deals going into contract, which were up in July, August, September, October. Closings only started to go up in September, but they've stayed up because remember, there's a delay between when something goes into contract and closes. But you can see right now, all the numbers are black. Everything's just way up from last year, which comports with those national numbers that you talked about. And here you can see the rhythm of New York and the new contracts. The orange line is this year, blue line is last year. So you can see how the orange and blue line track. They were close up until March, then they started to deviate, and then they crossed again in June when 2020 started to blow out the numbers compared to last year. And that's new contracts in New York. It's the same story in New Jersey, where the new contracts in Jersey for the last 4 or 5 months have been well above where they were in 2019. And here you see the same story in listings. Listings, they caved in during the height of the pandemic, and then they went up and they've stayed above last year's levels for most of the last 4 months. And, but the fact is, even with all those new listings, the rate of contracts and closings, and the fact that we had so few listings in April and May means our inventory is still low, which has had an impact on pricing. Just if you want to see side-by-side comparisons of this year and last year, you can see sales down. Sales this year, October 2020 is the blue line, how sales are up under contracts are up, new listings are up. This is northern New Jersey. And then if you look by county, you can see that pretty much the numbers are up across the board in every county, regardless of price point. This is basically consistent with everything you saw nationally, right? Right, Dan?
Yeah, absolutely.
So I'm leaving this up for a second because people live in different counties. So I want them to find their county and be able to go, all right, Passaic up 22.5% in sales, up 42%, 43% in contracts, up 18% in listings. And New Jersey pricing, this is the other thing that we're really seeing, is that this amount of demand coupled with low interest rates is really driving some dramatic increases in prices. Now, affordability in terms of the monthly payment you have to make is still flat or down, because as the prices go up, the rates are going down, and that's keeping the monthly payment down. But from a seller's perspective, this is wonderful. I mean, you're seeing, October 2020 versus October 19, a 17% increase in the average property value in Bergen County, which is off the charts. It's not sustainable. So don't anybody think that this is going to continue. Some of this is being driven by the fact that for once, the higher end is a little busier than the lower end, as you can see from some of the other markets that we'll look at. But I mean, generally speaking, this is a rising tide for everybody who owns a piece of property. New York region, I'll leave this up for a second so you can find your county. The same basic story. You've got sales up, you got contracts up, you got listings up. One thing I will point to is, we'll get to it in pricing, but these are, the market is as hot as I've ever seen. I've been doing this 20 years. My real estate company has been in business for almost 40 years. There's never been a market like this over a 2 or 3 month period. Nothing like this. This is a combination of low rates, suppressed demand during the pandemic, and an increase, a surge in demand coming from Manhattan that's just adding to the flow of what was already here, and it's just driving some real burst of activity. Here you can see last year versus this year in the region. Sales way higher this year than last year, contracts way higher, new listings way higher. But you also get a sense the proportion, right? That listings are, there are more listings than there are contracts, which makes sense, and how they relate to last year. So you get a sense of the proportion that we still have more under contracts than closings, which means that we still have this massive pipeline that has to close. And then New York pricing, same story that we had in New Jersey, where the pricing is way up. Westchester single family up 19%, Putnam 15%, Rockland almost 16%, Orange almost 20% from last year in October. Now, the one thing I will say it again, pricing is up. Part of it's organic growth, and part of it, and driven by what we've talked about, rates and everything else. And part of it is the fact that we are seeing more demand in the upper half of the market than the lower half. And that's because all that demand coming from New York City, those people are generally higher end buyers. That's part of it. The other part of it is that the economic challenges of the last 6 months that were occasioned by COVID have disproportionately hit people at the lower end of the income spectrum versus the higher end. It's one of the real unfortunate aspects of this, is that it's hit people who can afford it the least. It's hit them the most. But from a housing market perspective, what that means is that entry level, the people at the lower end of the price point, that market is not as robust as the upper level market, where you've got a lot of people who, they didn't lose their jobs. They're just working from home, and now they want a bigger home. And you can see this in this next graph, which is that condos and co-ops have not had the same appreciation, and they're the entry level market in each of these markets that you have. So Westchester condos are up 9%, but single families are up 19%. You just don't see that kind of spread unless there's really a divergence between the demand in the higher price points versus the lower price points, because the condos and co-ops are the lower end entry level price point in each of these markets. And what will really help the housing market next year is if the economy improves, which, like you said, the vaccine and everything like that will drive a lot more activity in the lower end, which is good overall for the market, because the market comes up from the roots. So you get a lot of people buying a home that's a condo. The person who sells that condo goes and buys a house. The person who sells that house buys a more expensive house, and it goes all the way up. So we've also already got a lot of demand up here. If we get a lot of demand down here, oh, it's going to be a huge year next year. So the market is surging for the reasons that we've already talked about. The pent-up spring demand didn't go away because the economic difficulties did not necessarily extend to the people that are generally buying homes in this market. Low interest rates sustained demand, and then we had a spike in buyers coming from New York City. My long-term take on the market, we know the year is going to finish strong, Dan, because we already saw the opens. Like, we know that we're going to have a huge closing fourth quarter, maybe one of the biggest in history, because the open pipeline, the cake's already baked for the fourth quarter.
That story's been written already. It's in the pipeline.
Yeah, it's people say, well, what's going to happen in the fourth quarter? I'm like, sales are going to be up 30 something percent. Like, how do you know? I'm like, well, because pendings are up like 40 or 50%. So, it's only, I don't have a magic ball. I just know that, like, if I go in the water, I get wet. What opens eventually, 95% of what opens eventually closes. There's no sign of demand slaking. The work from home thing is here to stay. We're going to see, I think, some permanent changes in consumer behavior based on what we've learned over the last 8 months. And I don't see demand I think the density is going to be, I think people will go back. I think New York City is going to be fine in the long run, but I think that in the short run, we're going to see a lot of demand coming out of the city to where we are. I really think that what's going on right now is that people who were thinking of leaving the city at some point in the next couple of years all decided to leave now. Like, they're like, why am I sticking around now for another year or two when it's going to be, everything's closed and the whole bit, it's all, you can't go anywhere. Listings
but also on that note, there's been a lot of people who couldn't move for different reasons that still want to move. And so I think that, next year is still going to be strong. Although a lot of people did spurt and move, there's going to be hopefully, 3 tiers that are going to be continuing to move and for different reasons throughout the year. I know that some people have lost their jobs or they're furloughed and they're just getting their jobs back now, or they're not even getting their jobs back till next year. So if they wanted to move, they'll have an opportunity to move next year or the following year.
All right. And we're going to see listings pick up. I think this probably in the fall, they'll be above last year. They'll be above last year in the spring. And the reason for that is when prices go up, basic supply and demand. When prices go up, that brings in more supply. More people say, ooh, prices are up. It's a good time for me to sell and get down to Florida, or sell and get a bigger home, or whatever the case may be. Prices going up tend to create more listings. And we've already started to see that, and we'll see it some more. And generally speaking, my take is that if the interest rates stay low, the market will be fine. I think that the one thing that could spook the market would be interest rates. I do think there's some concern about the, economics. We have, with COVID and the impact of COVID and the fact that the unemployment is running out at the end of December if they don't extend it. The extension of unemployment for people. There are some concerns. I think there's some, there's some political challenges going on in Washington right now that I think are probably not good for the stability in the market, but hopefully those will resolve, and we'll see some movement that will help. And just even stability helps, predictability helps. And just to review your 7 takeaways, just review them again with us now, just quickly.
Absolutely. Rates are at an all-time low and affordability is at an all-time high. Consumer trends and digital mortgage applications have changed. Electronic closings are being widely accepted across the country and may be here to stay. Mortgage satisfaction scores have doubled from 2019 to 2020. Mortgage refinance units will drop off in 2021 and again even lower in 2022. Purchase mortgage units will increase in 2021 and 2022. And new and existing home sales are expected to increase in the next 2 years. So
both nationally and locally, we'll see the same thing locally that we see nationally. The market across the country is being driven by the same forces that are driving our market. The difference in our market is I think we've got a little bit of a supercharge coming from people leaving Manhattan. All right, let me go just to see if there are any questions that came out of the of Facebook that I see some comments here. can I get to this? I know Imelda, are you there? Do you have anything you want to throw into the chat? Any good questions that want to come in? Let me see if there's anything here.
Joe, one of the questions that did come up was when Dan was talking about the refinances. Does he see, or does the forecast say that the rates on the refinances are going to change drastically with the number of refinances dropping in 2021 and 2022?
No, that shouldn't be an indication of where refinance rates are going to go. In fact, when the demand is really high, the rates tend to tick up for refinance a little bit. You can see on the graph when you see refinances trending and then purchases trending. When refinances volume really boom, the rate tends to tick up a little bit. So as they go down, the rates index should return to normal, where refinance rates are a little bit cheaper than purchase rates, actually.
And I just want to point out, we did have a nice comment in the chat from Don Arache, who's one of our top loan officers in the company. We had a nice comment that came in from Anthony Nicholas. Ricky Maddox had a comment. But the thing that Don had to point out, he said, the nice thing about refinances is that it puts more liquidity. It puts more, in some cases, people are doing cash out refis as well as rate refis, and they're getting money to do home improvement, or they're getting money to put back in the economy. And that's always a good thing. You know, that at the very least, anybody who is hearing this and is, you know, has an interest rate above what's the point at which you really should think about it? 3.5%, 4%?
Yeah, sure. 3.5 or 3.4. You know, everyone's situation is a little bit different. And like you said, a lot of people are looking for cash out.
Yeah, it's going to be different. But like, my point is that if you have not refinanced in a couple of years, you should really call somebody, because like there is, you might be, it's a little, it used to be a lot more work. Like you said, those customer satisfaction scores are much better now, because it's a lot easier to refinance than it was even like 2 or 3 years ago. So if you remember, oh my God, I don't want to go through that whole process again. I've gone through the process recently, and it really was relatively painless. You know, it was a lot of tapping on the screen as opposed to having to sign documents and do the whole bit. And getting the documents is a lot easier when you're just exchanging a lot of PDFs as opposed to having to go track stuff down. And the fact is, like, you could save hundreds of dollars every month, you know, thousands of dollars a year you could save with just a quarter, half point slash in your fixed rate. And you can lock that rate in. If you're going to stay in your house for a long enough period of time, you lock that rate in for 15 years. You know, who knows what rates are going to be like in 10 years. You could be sitting there with a 2 3/4 30-year fixed rate interest rate mortgage and laughing at your neighbors, you know, whatever they're getting in 2030 to when they buy their home or refinance their home. All right, Dan, anything else you want to add for our friends watching?
Just that, you know, give Hudson United a call if you're looking to refinance or you're looking for a purchase right now. We can help you get your pre-approval set up, or we can help you with your refinance. www.hudsonunited.com/mortgage.
HudsonUnited.com/mortgage or Rand Realty on the real estate end. Thank you all for watching. Thank you, Dan, for taking the time to pull out all that information. That was really interesting, really useful. I appreciate everybody's time. I hope you all have a great day, and we'll see you soon. Thanks, Dan.
Thank you.
Bye-bye.